Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Let's start today with the AI race between the U.S. and China. Now, we know that Nvidia is being allowed to sell its H200 AI chips into the Chinese market, and we are learning at the same time that the Trump administration felt this move carried a lower security risk, and that, in the administration's view, is because China's Huawei Technologies already offers AI systems that are comparable to those from Nvidia. Let's take a closer look at all things markets. We'll begin with the AI story in China with our guest, Qi Lo. He is Global Market Strategist at BNP Paribas Asset Management. Qi, it's always a pleasure. Thank you so very much. Give me your sense of where we are right now when you look at the domestic chip companies in China and how they are succeeding in producing products that are comparable with those of Nvidia.
Well, if you look at the past 3 years development of China's semiconductor chips production or manufacturing, the Chinese companies have actually moved very fast. And partly and ironically, I would think Mr. Trump's policy of export restriction of high-end chips to China, because that actually produced a force to push China to go faster than it actually originally planned. So China has managed to supply the world a few times with the speed of production of AI chips, although at this point, the quality of China's semiconductor chips is still not as high, as good as those in the US and in Europe. They are moving very fast. So yes, it's good news that Mr. Trump is now allowing Nvidia to export the X200 chips to China, which will help China to resolve the short-term need for high-end chips. But longer-term, strategically, the Chinese government has decided to develop their own without any reliance on any foreign producers in the longer term. This is very clear from the dual circulation policy that Beijing announced in 2020, that in particular, it says that it wants to pursue import substitution for the tech sector, i.e. not really relying on import of foreign technology anymore in the long term.
So to what extent do you believe the tech sector, whether it's AI in terms of software and some of the models that are being created by developers in China, or whether it's more focused on the chip industry in China, to what extent is this going to drive economic growth overall in the new year?
The manufacturing of the chips is the foundation for the development of the tech sector, which in turn will go a long way to affect or improve productivity, which in turn will affect economic growth in the long term. So China is going to go as fast as it can to produce all those chips that it needs and doesn't really want to rely on imports, as I mentioned earlier. But I think more importantly is the innovation of using those chips. China has gone way faster than the US, than Europe in terms of innovation. The invention part, China is catching up. Innovation part, I think China is leading. So from that perspective, I do believe that in the coming years, we will be seeing an increase in Chinese productivity growth because of the tech development, which in turn will go to boost economic growth in the longer term.
So we're in Q4 now. Do you believe that China will achieve the 5% growth target for this year that it set previously?
I think highly likely that China will get 5% this year, because even if the Q4 growth were at around 4.5%, which is what the market consensus is, China will get 5% for the full year. Going into next year, I think we still are likely to see between 4.5% and 5% growth for 2026.
In terms of the export economy, one of the things we learned from the recent trade data, despite the tariffs, that China's export economy is holding up very, very well. What other markets do you see China focused on? Let's forget the U.S. for a moment, to kind of make up for the difficulties that the American market represents.
Well, obviously, it is all these developing world markets, especially those in the Belt and Road Initiative framework. Because when you look at the data, since about 4 or 5 years ago, China's total exports to the Belt and Road Initiative countries as a region has overtaken the US and Europe combined as the largest export destination for Chinese goods. So I think this trend will continue because China is putting more efforts into developing new markets in the developing world. There's still, Africa, there's still Central Asia, there's still, the Middle East that China will continue to expand. And all these countries are joining, many of these countries are joining the Belt and Road Initiative framework. So this strategic move of the Chinese government to sort of manage the trade tension with the developed world is to focus on the developing world, which, there's a lot of room to grow.
Let's look at another point of tension, that being between Beijing and Tokyo. We know that the recent comments on Taiwan from the Japanese Prime Minister kind of rattled the administration in China. How do you see this progressing, and what is the economic risk that kind of remains looming over this relationship?
Well, I'm hoping that the quarrel between Japan and China over the new Japanese Prime Minister's comment on Taiwan will be resolved soon. But when you look at the policy development, the statements from both governments, it doesn't seem to be that the tension will go away anytime soon. Now, if you look at what happened last time in 2012, China, Japan went into a similar kind of political tensions, war of words over some, East-South China Sea, a territorial dispute. It took a few years to get the two countries' relations normalized, and Japan's economy was affected negatively by that dispute because exports from Japan to China fell, especially those consumer goods, especially the auto and related goods, and also because of the decline in Chinese tourists going to Japan that actually reduced a lot of the Japanese export tourism exports to China. So that hurt Japan back then. Now, this is happening again this time, that we are seeing China stop buying many Japanese exports, this time especially seafood and stuff. But also we are seeing less and less Chinese tourists going to Japan. But there is difference this time from last time, because last time the Japanese exports of intermediary and capital goods to China weren't affected much because China needed them. But this time, 13 years after the last dispute, China has gone up the value-added ladder, China has gone up the technology ladder. So that means many of the Japanese capital goods exports to China will be hit this time because China doesn't need to buy from Japan and replace them with domestic production. So that's point number one, that there's going to be a bigger hit on Japan's export to China if this quarrel continues to go on for a little while longer. And then on tourism, the impact is even bigger because today, Chinese tourist spending in Japan is 10 times more than Chinese tourist spending in Japan 13 years ago. So that hit on Japan's tourism exports to China is going to be bigger. So when you put all these economic impact together, I think if the quarrel drags on, there will be some material negative impact on Japan's GDP growth, which in turn could even affect the BOJ's plan to normalize policy by increasing interest rates.
So that is a perfect segue into our next topic, which is the BOJ meeting next week. The market right now seems convinced that we could see a rate hike after a period of inflation in Japan that's been going on for many, many years right now. And we know that the weakness in the currency is persistent. If you talk to people who live in Japan, they very much feel the effects of higher inflation. What do you expect the BOJ to do next week?
I think it's likely that the BOJ will do another quarter point hike, as the market expected, which will take the BOJ policy rate to 0.75. But what I doubt the BOJ can do is next year. The market is pricing in, I don't know, two hikes by the BOJ next year. I am not quite certain about that because partly because of the economic impact on GDP growth that we talked about earlier due to the Japan-China dispute. And also, when you look at Japanese GDP yields, they've gone up a lot on the concern about the new prime minister's fiscal expansion, and on top of the high debt burden that Japan has already built. So that high bond yields is to some extent doing a tightening for the BOJ, which means that if higher yields with and then also political tensions do hurt Japanese growth and reduce GDP growth rate and inflation comes down a bit, I don't think next year there will be very strong reasons for the BOJ to keep hiking rates. But time will tell. This is my concern at this point, that next year the BOJ's policy path is not as clear as the market now are expecting.
Chi, we'll leave it there. Thank you so very much. Chi Lo is Global Market Strategist at BNP Paribas Asset Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So the Fed's rate decision is Wednesday, and money markets are pricing a likely quarter-point cut, with around 2 rate cuts in the new year. Now, this is a bit of a retreat from more optimistic forecasts for rate cuts that have been delivered in recent weeks. Now, at the same time, President Trump will reportedly launch the last round of interviews for Fed Chair this week. The Financial Times is reporting this will pit White House economic advisor Kevin Hassett against a trio of other candidates. Now, President Trump was asked to comment on the FT report.
We're going to be looking at a couple of different people, but I have a pretty good idea who I want.
That was President Trump speaking earlier to reporters aboard Air Force One. Now, Hassett is considered to be the front runner, and today he said that he sees plenty of room for the Fed to substantially lower rates, even more than a quarter point. Hassett told a Wall Street Journal event he would rely on his own judgment and not bow to political pressure to decide on whether or not to cut rates, should he become the next Fed chair.
If the data suggests that we could do it, then like right now, I think there's plenty of room to do it.
Plenty of room, which plenty is more than 25 points.
Correct.
That is NEC Director Kevin Hassett. For a closer look at the outlook for rates, I am joined by JoAnne Bianco. She is partner, also the Senior Investment Strategist at BondBloxx Investment Management. JoAnne, thank you for making time to chat. Are you on board with this consensus call for a quarter-point cut?
Yes, definitely. Definitely expecting a quarter-point cut at tomorrow's meeting. Again, this is something that could continue to be one of their precautionary or risk management type of cuts.
So you would call it a hawkish cut then?
Yeah, I think that, to me, it doesn't seem like, first of all, there's been a lack of data, but we need the data to actually show that more rate cuts are warranted to have, an environment where you see multiple rate cuts next year. We're really just not there yet, thinking that that's something that's going to be happening or warranted.
So in the absence of the government data, that obviously as a result of the government shutdown, you've been forced to look at a lot of the private surveys. What is your takeaway when you look at those numbers?
It still seems like there's softening trends overall in the labor markets, but it's not dramatic. I think the thing that we have found supportive of, just the resilient U.S. economy is just how strong U.S. corporate earnings came in. And I'm looking specifically at high yield corporate bond issuers. We have a lot of ETFs in the U.S. high yield market, and earnings have held up really well in the third quarter, and guidance was increased for a number of companies. So those are the kinds of things that make me think that this is not a U.S. economy headed towards a recession or headed towards an environment where you would where rate cuts would really be something that could help prop up an economy.
So how do you feel about inflation? Now, we know whether you're looking at the PCE or even the CPI, the core rate of the Consumer Price Index, we're still above the Fed's 2% target. Things appear to be, on the price side, a little sticky here. What's your outlook for inflation?
Yeah, that's a wild card. That's a wild card for next year. The thing there is that if we did see some over easing by the Fed, that is something that could cause inflation to reaccelerate. So like all the good work done to bring inflation down, it could come back up. It's still above target, sticky around the 3% level. And it's something that I think that that's part of the reason why we've seen bond yields go up in US Treasuries, especially over the past week. We're up like 10 or 11 basis points on the 10-year. And I think that's because the traders are nervous. They're jittery about like the potential for over easing and reaccelerating inflation.
What is your sense about the volatility that we're going to see ahead for the bond market? I think there was a little bit of chop, certainly in the bond market in 2025.
Yeah, it depends on what you're talking about. The corporate credit markets have held up very well. Fundamentals have held up really well. The returns for triple B corporates here in the U.S. and double B corporates and a number of industries have been, really strong this year, supported by the strong fundamentals that we're seeing. Where you see more volatility is in the long end of U.S. Treasuries. And that's an area that we still recommend to our investors to be underweight because, there's just too many factors going on in terms of fiscal spending, inflation, all that makes the long end or long duration sectors a lot more risky.
What do you think about the level of debt issuance that we're going to see going forward, particularly as it relates to what appears to be an AI winner-takes-all arms race?
They're all coming to market, and they're very long-term projects, and there's a lot of financing needed. This is something that can change the complexion of, the credit markets in terms of a lot of these deals as they come to market. So time is really going to tell on that. We hope that there isn't a situation where there's massive overbuilding, because that, anytime there's real excess that develops in the markets, in credit sectors specifically, it doesn't seem to end well.
But these companies have very good balance sheets. I mean, isn't that worth the risk?
Well, I mean, right now, they're investment grade type of credits for sure. So it's just really a factor of just making, at some point the demand side of the equation really catching up with what will be the supply.
Where are you finding opportunities these days in the bond market? You mentioned how certain areas of the corporate credit market interest you.
Yeah, we still really like corporate credit sectors because of the strong fundamentals that we're seeing, and so you're getting nice yields, not a lot of volatility. We're not expecting that we're headed into the next credit down cycle. Defaults have been lower than average. The level of distressed securities have been lower than average. There's been very healthy new issuance that's been focused on refinancing debt as opposed to really speculative sources of new capital in the high yield market. So we still really we specifically really like triple B corporates, double B corporates, private credit. We also like emerging markets as well. We've seen that's actually been our best performing fund in 2025, a US dollar denominated sovereign debt fund. And it's up over 13%, and so it has a nice yield. There's been price appreciation, still has a nice yield, and we're seeing improvement in emerging economies that warrants this.
So as you look out, I mean, if we're right in expecting multiple rate cuts in the new year, is the strategy here to kind of lock in some capital gains when you look at these positions that you're building right now, or do you hold to maturity?
I think that we're not necessarily expecting multiple rate cuts. Okay, so we expect December and maybe one or two rate cuts next year. So it's still going to be, it's elevated yields plus some price appreciation, but it's not necessarily where we think we're going back to the rates we saw before all the increases in Fed policy rates.
JoAnne, thank you so much. We'll leave it there. JoAnne Bianco is partner, also senior investment strategist at BondBloxx Investment Management, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.